Welcome to Family Matters, Legal Edition, a special monthly segment of the Business of Family podcast. I'm Tammy Buss, family business advisor and founder of Blue Roots.
And I'm Yola Ventresca, managing partner at Learners LLP. Together, we're diving into the legal issues that impact family businesses, from succession and shareholder agreements to conflict resolution and governance.
Whether you're in the founder's seat, part of the next generation, or advising a family-run company, this series is here to help you navigate the legal side of legacy with clarity and confidence.
Join us every third Tuesday of the month for real talk, real stories, and practical legal insights.
Because in family business, the law isn't just about protecting assets, it's about protecting relationships. So today our guest is Ray Adlington, and for those of you who can't see him, he's got gray hair, and he's earned that from being a lawyer since 1997. And he focuses mainly on corporate tax, personal tax, commodity tax, and a little bit of dispute resolution in there on behalf of taxpayers, because he likes to argue and needs a constructive outlet, because I'm sure your wife would appreciate that.
I'm married with 2 daughters, so I need an outlet outside the home.
Because you can't argue in the house. You
well,
will lose
it's
every argument.
where I have a chance of winning an argument.
That's right.
Yeah.
Yeah, that's true. And so you've worked in Halifax for over 20 years, and now you've come to Ontario, mainly because of the 2 daughters that you had mentioned.
That's right, yeah.
And came back here. And you've worked with a lot of family businesses and very high-profile family businesses.
I actually did a count a few years ago, and I was up over 1,500 different families that I had worked with over the years. Entrepreneurs have been my client base since the late 1990s because coming out of law school, I decided I was less interested in the area of law and more interested in the type of people that I wanted to work with. And the entrepreneurs are my peeps.
Yeah. And you've been very involved in bar associations and anything sort of in the I guess the realm of law and compliance and all that good stuff.
I've done the tour. I was on the CICA-CBA Joint Committee on Taxation for a few years. I was involved with the Society of Trust and Estate Practitioners for a few years. I was the president of the Canadian Bar Association. I've been involved with the Canadian Association of Family Enterprises. I've sat on the board of the Atlantic Provinces Economic Council.
So the gray hair has been from a lot of different areas, isn't it?
Yeah, it's all earned, usually through close calls.
Yeah. And so what I really like is the fact that, you not only work with the family businesses, but your specialty is about cross-border and understanding the complexities that come around being a family in business, and also, when you are outside the Canadian borders, or even just from province to province. So we're really pleased to have you here today.
Well, thank you. I appreciate the invitation. That is sort of the modern family doesn't usually just touch one jurisdiction.
Yeah. No.
So today we're going to unpack cross-border corporate and personal tax planning, why it matters for family businesses, how global footprints create hidden risks, and what families need to think about before tax issues become expensive surprises.
So what does cross-border really mean?
Really, we're not talking about provincial borders so much, simply because the tax system across countries tends to be pretty homogenized. What we're really talking about is across national borders. So anytime you have assets that are crossing national borders where the person that owns the asset is in a different jurisdiction than the asset itself, or where family members are in different jurisdictions, different countries, or where you have income sourced from a different country, whether that's business income or services income, whatever the nature is. That's where we really mean when we're talking about cross-border, is more than one taxing jurisdiction has an interest in you.
And what are some of the things that you see with family businesses that they're maybe not even aware of with cross-border?
Sometimes it's citizenship. The U.S. famously taxes its citizens and not every person is aware that they actually are a U.S. citizen. So that's a fairly common one, especially for people within Canada who live here, may not necessarily be aware that one of their parents was born in the U.S. and therefore they are a birthright citizen and have compliance obligations in the United States. Another sort of common example is parents not necessarily knowing where their children are living at any given point in time, because you don't always have constant communication with your children, I've learned, as they've grown up. Sometimes I think the term is ghost. They ghost you from time to time. And then the final one is people just simply not being aware that countries tax based upon source and not just simply based upon where you live. So having sources of income in other countries, people aren't necessarily as aware of what the tax obligations are. And particularly in business, when you start investing in other jurisdictions, you're generally familiar with the tax compliance obligations and the tax in your own home jurisdiction, often less aware of what the tax obligations are, whether they're compliance or payment obligations in the area, the jurisdiction in which you've invested. One thing I've noticed about entrepreneurs is they tend to be running full steam ahead towards the next business opportunity. And it's only when you sort of reach my stage of life, when you're huffing and puffing as you run, that you start looking over your shoulder to see what's coming behind you.
Right. So you mentioned that you'd worked with upward of 1,500 families. Families. How, in that work, what can you tell us about how personal and corporate tax issues are connected or interconnected in family enterprises?
Sure. So, the first threshold question is there's often opportunities to decide at what level tax is going to be paid, whether tax is going to be paid at the personal level or whether tax is going to be paid at the corporate level, or whether it's going to be a blend of the personal and the corporate. Once you start introducing new jurisdictions into that, now that brings in a whole host of other choices about which jurisdiction you might end up paying the tax in, where a choice is available. What you want to avoid, of course, is the double tax or the triple tax situation where you're paying corporate tax in one jurisdiction, personal tax in a second jurisdiction, and personal tax in the jurisdiction of source.
Right.
So that is one area where you kind of get into the blend of the personal and the corporate tax situation. Death is a big event in all jurisdictions with respect to tax. So we are often planning for that eventuality. We in North America are not great at talking about death. So, and planning for that eventuality. So that is something that we are often called upon to do as well, is working towards ensuring that the family has a smooth transition through the loss of a loved one, from both a business and a tax perspective, that the quantum of tax that might have to be paid at that particular time doesn't force a liquidation of business assets that the family would like to actually keep and keep operating, because it's part of their id, their identification, who they are,
Right.
the family business.
And I guess that's where ideally families would have had conversations with someone like Tammy before we get to the point that there's a death and no one has spoken about it, right?
Absolutely. Absolutely. And we also tend to focus on the accountant for the tax advice as opposed to just a lawyer. So I found it very fascinating when I met Ray. Thought, like, this is a lawyer who focuses on this tax and not just about the dollars but the structure.
That's right.
Which is really key, I think, for this whole conversation.
Oh, absolutely, because you have different types of structures that are available in different jurisdictions that come with different tax consequences. Like, Americans love their LLCs, love them. The limited liability company, I think you know what I mean,
Right. Yep.
Right? in Canada, if an entrepreneur was investing in the United States, the LLC usually is not the optimal structure for making that investment into the United States. But because the LLCs dominate the mainstream media, unless you have that conversation in advance, your default setting is probably going to be to form an LLC in the US. And now suddenly you've created yourself a potential problem. The converse is also true, that if a US person was investing in Canada, they might just simply say, well, here's this Canada Business Corporations Act, I'm going to form a Canadian company, or I'm going to form a company in Ontario because I want a business in Ontario. Where for a US person who is looking for flow-through taxation rather than entity-level taxation, they're better off having an unlimited liability company formed on one of the coasts, whether that's British Columbia or Nova Scotia, that then registers to do business in the other provinces. So the structuring matters in both directions. And, you know, I'm using the US as an example, but of course these structures exist with European countries, with Asian countries, where you've got all these different types of business structures, ownership structures for assets that have different meanings.
Mm-hmm. Mm-hmm. So, you know, when you look about that worldwide and you look at residency and income, so what is the residency that causes the tax, you know, obligations, or is it not necessarily residency? How is that determined? Is it by country?
Every country has its own set of domestic rules for determining tax residency. The United States, as I mentioned, talks about taxation based upon citizenship, but there's also a residency-based taxation obligation as well in the U.S. So that if you are a U.S. resident, you are a U.S. taxpayer. If you are a U.S. citizen, you're a U.S. taxpayer. If you're a Canadian resident, you're a Canadian taxpayer. Every country has its own definition for what residency means. In Canada, we have this nice bright line test of ordinarily resident, whatever that means. I mean, being a little facetious when I say bright line test. So the Canada Revenue Agency and the courts have developed a number of guidelines in terms of what it means to be ordinarily resident. It's entirely possible, and in fact, frequently occurring, that one individual might be considered a resident under the taxing legislation of more than one country. Mm-hmm. So if you meet the definition of being a resident of one country under their laws, and you meet the definition of being ordinarily resident of Canada under our laws, now you're potentially subject to the tax systems in both countries. Well, you are subject to the tax systems in both countries. Mm-hmm. In those situations, Canada and most OECD countries have a network of bilateral tax treaties. And those bilateral tax treaties have a tiebreaker rule. If you're looking for them, they're usually found in Article 4 of the relevant tax treaty. And that's because the OECD has a model tax treaty that most countries adhere to, and the structure of the tax treaty has the residency always stuck into Article 4. Now, what the tiebreaker rule says varies treaty to treaty, but you will usually find it in Article 4. So the U.S., for example, has a substantial presence test, that if you're physically present in the United States for any day or any part of a day, and that number exceeds 183 on sort of a rolling 3-year weighted average basis, so you take the number of days from the current year, and then you add in, I think it's 1/3 from the prior year and 1/6 from the year before that, and if it adds to more than the total, now you're a tax resident of the United States. Mm-hmm. So if you're a tax resident of Canada under the ordinarily residence test, and you're a tax resident of the U.S. by virtue of the substantial presence test, now you need to go to the treaty tiebreaker to break the tie. In terms of deciding, okay, well, which country do I actually have to report my income in? Mm-hmm. And in the other country, you still have to file a return, but it's what we call a treaty-based return, where you can simply claim the treaty benefits and say, sorry, I know I passed your test, but I don't have to report here. No. And then you sort of move forward on that basis. But
and I'm finding more of that happening now because in family business, the borders is, the borders are easier to cross now to do business. And a lot of times, the next gen is actually working in another country and kind of living there, looking after, a portion of the family business, or they're gone. As you said, you don't even know where they are now. They could be in, Hong Kong. They could be in, Taipei. They could be in Paris. They could be anywhere now in England. And they're there for, maybe a year or two and then moving on, right? So it becomes quite complex.
Or they're over there managing a division of the family business.
Yeah.
I've seen a number of immigrant families where the first generation immigrant ends up going back to the old country, so to speak, to, manage the legacy business assets that got them launched before they came to Canada. So immigration and emigration happens all the time, as you say, in family business, and multiple residents under the domestic laws of the different countries is fairly common. The challenge is if you don't recognize it and you fail to report, now you're subject to potential double taxation because you've lost the treaty benefit and you're subject to potential penalties for noncompliance.
And it's not like that and they tell you that the minute you show up, right? Because again, like I said, of lots of family businesses now who send, their children off to manage, like you say, a factory or something, or a build that's taking a couple of years and they're stuck in another country. Not stuck, but they're in the other country and they're not really, back in Canada or the US even, like they're gone. So I find it's very interesting now and very complex, and the fact that you need both the accountant and the lawyer to talk about this, I think is, amazing. Like, you really do need to look into this. You don't get yourself in trouble or end up in jail.
Absolutely. And we have our lanes in terms of where the, there's overlap, but we have our lanes, right?
When would you normally get called in? Other than the problem. Yeah, as a lawyer.
Typically, certainly if there's ever a problem, but most often when people are planning a large investment or a large move, or when they have finally turned their attention to doing succession and estate planning. And then occasionally on the annual type planning as well with the accounting firms too. We do some of that just around cash flow for the family. Because, again, my experience with entrepreneurs is they tend to treat their companies and their businesses like it's their personal change purse. Right?
So true.
You have a little bit extra money, you put it in the change purse, and that's where it goes to sit for a while. You need a little money, you take some out of the change purse, and then you go off and you spend it on whatever it is you've decided you want to buy. And that's true no matter where they have to be physically sitting at the time.
Right.
So you don't always know which pocket the entrepreneur is going to be pulling money out of. So that usually requires a little bit of planning at the end of the year to get sorted out.
In your view, why, when people are exposed, why don't they realize they're exposed?
Lack of information. It would be
number one.
Number one. It's just simply there's no road signs. You don't sort of get that advertised of here's your speed limit. Yeah. So, a U.S. citizen living in Canada, there's no road sign that tells them they have to file a return in the United States every year about their foreign bank account, even though they live in Canada. So there's just no road signs around all the different things that have to get filed.
Well, you think if you're in the U.S., you're going to have a lawyer and an accountant who's familiar with that area.
Yeah.
And then in Canada, you have that. So, how many actually understand cross-border?
Yeah, that's right.
I think within Canada, you're probably looking at fewer than 1,000 accountants and lawyers across the country would be practicing in this space and have an understanding of what the rules are in different jurisdictions. And the converse is also true in Canada. If you invest and you start up a business in the United States, you've got an annual filing you have to do if you've incorporated a company in the United States with respect to what we call a foreign affiliate. So if it's a controlled foreign affiliate, there's an annual filing, and if you don't file, you've got penalties. If you own foreign property that's not for personal use, then if the cost amount of that foreign property is over $100,000 Canadian, there's a nice big box on the front page of your tax return that you're supposed to tick, and then you get to file an information return. Well, that can come up in a variety of different ways. I had a situation once where a client had inherited foreign rental property from her parents, and her accountant didn't recognize that this had a cost amount to the client of more than $100,000. Even though the client had inherited and not bought, that didn't change the filing obligation that where the cost amount for Canadian tax purposes exceeds $100,000, tick the box, file the form. So
scary, and I think so important in our profession generally, to get the word out about who actually has the expertise to do the work that you're looking to have done. I mean, fewer than 1,000, you said, in the country. Is that?
I think that's roughly a fair
maybe know a
assessment.
little bit, but not like a specialty, right?
Yeah, that's right.
Yeah. I'm talking about people who have a depth of expertise and experience.
What about, because I'm sure what happens now is you might not have a physical presence like a factory or an office in another country, but you may do business in that other country. Does that have an impact on the filing?
It can. If you have established what we call a branch or a permanent establishment in the other jurisdiction, then you are effectively going to be subject to that jurisdiction's income tax laws. So it really depends upon that physical presence. If you're simply selling goods or services into another country from your home base here in Canada, or the converse would be true, then you are likely not going to be subject to the tax regime of that other country, except potentially to the extent that you might have commodity tax type, value-added tax type exposure, like our HST equivalent.
Right. Now, we do find that, with family businesses, if you do have a child or a sibling that lives in one jurisdiction and you're in another. So let's say it's, two sisters, and one lives in Canada, one lives in the U.S., and the company is actually in Canada. And they both have shares, and, how does that even come into play? Because now you're down there doing work, or even you're not doing work. You might just be an owner and not actively involved in the business.
Right. So in those situations, we always have to sort of come back to this concept that I learned at a young age, that fair isn't equal and equal isn't always fair. So we need to have a conversation with those two siblings to set their expectations around what each one of them might receive over time from the family business, the company, and so on. In that situation, there are planning opportunities, of course, because we have a different tax regime in the U.S. than we do in Canada. So if there was life insurance, say, in the structure, then we would generally want to stream the resulting capital dividend account out to the Canadian beneficiary, because that's tax-free to the Canadian beneficiary. However, if the U.S. sibling did not, or did receive half of that capital dividend, they would still pay tax in the U.S. on that dividend. So we would want to find other assets to compensate the U.S. sibling in relation to that. The effective tax rate on dividends in the U.S. is lower than it is in Canada. So we might sort of take taxable dividends and stream those to the U.S. sibling, knowing that their effective tax rate is lower than our Canadian siblings' effective tax rate. So there are planning opportunities. If it's a Canadian company paying a U.S. taxpayer, then we have a withholding tax obligation. Somebody needs to make sure, again, to stay compliant, that we are withholding and remitting to the Canada Revenue Agency. That then enables our U.S. person to get a foreign tax credit for the Canadian tax paid to avoid double taxation.
Because it does become quite complicated the deeper the generations you go, right? Because you can then have, from the ownership standpoint, you can have several owners that are not really involved in the business who are family members, right? I know one, they're not my client, but I know of one that there's 144 cousins
Wow.
in the generation, and I happen to know some of them. Some of them are in Canada, and some of them are in the U.S. And they're not involved in the business.
That's right.
And in fact, I'm not even sure that there's like 5 involved in the business, but it becomes quite complex, right? And I think in a lot of cases, it's sometimes easier to say, I don't want to deal with this. I just want to sell the company and not deal with it.
Over time, it becomes more complex, and over time, as each generation does their own planning, that introduces another level of complexity because you've got trusts potentially in multiple jurisdictions. You've got partnerships potentially in multiple jurisdictions, and you've got corporate entities potentially in multiple jurisdictions.
Mm-hmm.
And somebody has to be paying attention to the compliance obligations at all levels,
Mm-hmm.
and knowing how the different types of entities are going to get taxed in the different places.
Mm-hmm.
So if we were in a situation where there was a family business that was about to be started, give me the options. What are the options for people who want to structure a cross-border family business?
So the options for structuring a cross-border family business is, first you have to start in the home jurisdiction.
Yeah.
Where do most of the family members live? You are generally going to want some sort of corporate entity in that jurisdiction. So whether it's a limited company or some other form of corporate entity. And that's because the treaty system favors the repatriation of capital from corporation to corporation rather than corporation to individual. So just to sort of minimize the withholding tax when money's coming back, you're generally going to want a corporation at the top. And then once you are embarking outside of Canada or whatever jurisdiction, then you're going to want to start exploring what the options are. So for example, in the United States, there are C corporations, there are LLCs, there are limited partnerships, all of which can work effectively, but your choice will be dictated partly upon the industry, partly upon who you're going to be engaged in business with, and partly upon the state of the tax law at the time you're starting.
Yeah, and that's one that perhaps you can expound on that a bit about how the different corporate structures impact tax outcomes.
Sure. So it really comes down to whether or not a corporation is going to be considered to be a resident for the purposes of the tax treaty. And this is the challenge with the LLC in the U.S.,
Right.
is that it doesn't always get recognized as a corporation for the purposes of the Canada-U.S. tax treaty. So repatriating capital from the LLC coming back to Canada, we don't always get the tax treaty benefits that we would expect to get. A C corporation would be what most U.S. public companies would be carrying on business through. Regular corporation, no issues with treaty benefits and so on.
Right.
A limited partnership, if you start carrying on business through a limited partnership in the United States, now a partnership is disregarded in Canada, as we know. We don't necessarily all know that, but a partnership is considered a flow-through entity in Canada. So any income that comes into the partnership gets passed out to the partners for income tax purposes. In the U.S., that's not always the case. In the U.S., sometimes the partnership is itself a taxpayer and has to pay tax. It really depends upon whether or not the partnership has elected to be taxed as a corporation. In that situation, now your Canadian partners who are getting the income of the partnership allocated to them have already paid tax, so the partnership has already paid tax in the U.S., and you don't necessarily have a foreign tax credit alignment. So it's that mismatch that we're trying to avoid.
Yeah. And so context specific.
Yes. That's
Obviously.
a good way to put it.
Yeah.
There's no sort of easy pick it up off the rack solution here
Right.
for most families because the industries are all dealt with differently.
Yeah.
Mm-hmm.
How the business is generally conducted is usually different.
Mm-hmm. Mm-hmm.
And each family is its own construct around how ownership of the business is going to be set up.
That's right.
So, Ray, from your perspective, then, what you do is you come in and sort of as a project basis, correct?
That's right.
You don't replace their regular lawyer or their firm, but you come in to help sort of, preempt, make sure you're there to prevent any problems or get the structuring correct, and then called in to help when required.
That's right. I have ADHD, and I'm not very good at paying attention to things for a long period of time. So I go in, I do the project, usually 2 to 3 months, and then on to the next one.
Then out you go.
On to the next one.
Yeah. So, if you were to talk to families, when should someone actually reach out?
I think the optimal time to reach out is when there are major life changes. So succession planning is about to happen. There's been an emigration in the family. There's been a business sale or a proposed business sale. There's a significant business acquisition opportunity. There's a major new financing. You're going to go buy the significant new toy, whether that toy is a vacation home in another jurisdiction, or it's a floating vacation home that some of my clients like to have.
Yes, that's always an issue because they're always registered somewhere else, right?
Yes,
yeah.
The flagging for marine law purposes and the tax issues,
right,
don't always have the same solution.
Right.
And they're more focused on the flagging for marine law issues than they are the tax issues.
Right.
But again, it's the family change purse, right? Anytime you're going to reach deep into that change purse to buy the toy, then we should be having a chat.
Interesting.
Which I would assume would be very often for most.
Yeah. Yes.
Yeah. So call Ray.
Yeah, because particularly with the clients that I'm dealing with, and the demographics right now. I mean, boomers are 62. The youngest ones are 62 this year. So there's a lot of succession planning. There's a lot of continuity planning, not just succession, because succession is one period of time, one thing happening. Where continuity is that ongoing. But there's always a trigger of when you have to start to look at these tax issues. And honestly, I think it's fascinating that there's a lawyer that focuses on tax and tax issues. You always think of it as your accountant who has those answers, but there's more to it.
I can add just as fast as any accountant.
Well, I just want to maybe scare people a little bit. So,
Sure.
What are the consequences of not reaching out to you?
Look, you might get lucky, but the consequences can be becoming non-compliant in a particular jurisdiction and facing personal liability for taxes, even though the money has been bequeathed to other beneficiaries. If you're in an executor type role or a director type role, it's that personal liability that people really should be concerned about. And
I didn't know is no excuse?
Usually not.
I didn't know that.
You know what? It can help. It truly can help because oftentimes the taxing authorities in the different jurisdiction have jurisdiction to be able to forgive or ameliorate the penalties that they can impose.
Oh, right. Yeah.
So the I'm new here, I didn't know can go part of the distance, but the more sophisticated you are in terms of your world experience, the less likely you are to get away with that kind of presentation to a foreign taxing authority. The other challenge, of course, is you may not always find out that you have been personally penalized or have this tax liability until you enter a country, and then you get the surprise of border control. Right. So that's the other real downside that you want to avoid.
Scary.
Yeah, or you get sort of the thick brown envelope in the mail with a detailed audit inquiry that's 20 to 30 pages long that you could have avoided if you had simply gotten the advice up front.
That's right.
Yeah, around what your reporting obligations were. A lot of the times that's all it is reporting. There's no actual tax payable. That people are trying to avoid. It's just staying compliant with your reporting.
So what's the one thing you would say to our listeners today who have either, children in foreign lands or work, have businesses in cross-border, what is the one piece of advice you would give them today?
I would tell them to have their children or whoever is living in the foreign jurisdiction build their own network of professional advisors so that they can have access to that network when it's time to have the conversation and get the localized advice. Nothing beats local advice around what the current state of the law is in a foreign jurisdiction and what the attitude is of the revenue authority in that foreign jurisdiction, to be able and to sort of know people and know how to sort of move things along in a different jurisdiction. You know, if you were a U.S. person who was selling Canadian real estate, then you would want somebody in Canada that knows the process and knows how to work with the Canada Revenue Agency to get you your clearance certificate so that you can sell the Canadian real estate in a timely manner.
Well, that's really great advice.
Yeah, really great advice.
Really appreciate you coming in today.
It's great to be here.
Awesome.
Thank you so much.
I mean,
This great little room. And,
You've opened up so many different lanes that we could dig into. I mean, a lot of them is like, I'd like to know more about this specific topic. So thank you so much.
Thank you so much.
All right, thanks.
Thanks for listening to Family Matters Legal Edition. We hope today's conversation gave you something to think about or talk about in your own family business.
If you enjoyed the episode, be sure to subscribe, leave a review, and share it with someone who'd benefit from hearing it.
Have a legal question or topic you'd like us to cover in a future episode? Reach out. We'd love to hear from you.
Until next time, remember, in family business, what's legal is personal. Take care. The information shared in this podcast is for general educational purposes only and is not intended as legal advice. Listening to this podcast does not create a lawyer-client relationship. For advice specific to your situation, please consult a qualified legal professional.